Hi, I'm Rick Roughen with National Marina Sales. Thanks again for dropping in, and I'd like to welcome you to this last of two brief but very important discussions on the most critical issues you will face as you consider the prospects of selling your marina. The topics in our plate for this section are as follows. They are EBITDA and cap rates. Okay, so starting with EBITDA, the acronym stands for earnings before interest, taxes, depreciation, and amortization. It's really quite simple and can be explained like this. EBITDA represents your net operating income once you have erased the effect of interest, taxes, depreciation, and amortization from your profit and loss statement. The purpose is to remove non-cash items or any expenses that are not directly related to your business operation. Interest is recognized as your cost of money, but it is not an expense that has anything to do with the daily operations. Taxes refers to personal income taxes, which should not appear on the income statement in the first place, and they would certainly not be a business-related expense. Depreciation, though recorded on your P&L for its tax benefit, is not a cash item, which means you don't actually write a check for it each month, even though it appears as a monthly expense. Depreciation actually represents an allocation of the cost of the assets spread across their projected useful lives. And amortization is a lot like depreciation, but it only applies to the cost of intangible assets spread over time. So again, no check is written, and its true benefit and reason for being on the income statement is purely tax related. Once you erase those altogether or add them back to your reported net operating income, as the case may be, the adjusted earnings level we call EBITDA is where you arrive. When an accurate EBITDA number is determined, there is still work to do. Additional expenses flowing through the P&L that have nothing to do with the business are typically expensed for tax purposes. Those items tend to be personal in nature and may be better described as vacation costs for the family, a new car or two, new computers, a boat, or parts for a boat that sits in the owner's backyard. These are decisions made by an owner, and yet again, they have nothing to do with the business, so they are added back in whole or in part to the profitability reflected on the income statement. Buyers will recognize those items and will pay for the income they offset, so long as evidence can be produced to verify them during the due diligence period. Where cash is concerned, that will be a different story unless it is recorded in such a way that leaves no question in the minds of the buyer that it was actually received. It is far more difficult for a buyer to justify paying for dockage collected in a brown bag, and potentially more destructive to the reputation of the seller than it is worth squabbling over. So the best thing to do is to collect payments, create a receipt, apply it towards the customer's account, and make a bank deposit. The continuity in that process will alleviate the cash concerns. After all of that is taken into consideration and an adjusted EBITDA is reached, it is time to apply a cap rate or a multiple to the number and see what value emerges. Again, there is still work to be done, but this is the basic value determination platform from which there should be only a few further adjustments for exceptional items. Then it is time for the seller to discuss final pricing with his expert marina broker and begin to prepare the sales package. Okay, so we discussed how the cap rate is applied to adjusted EBITDA. But what is the cap rate? And who determines what it should be? Does a seller have to use a cap rate if he wants to sell his marina? What if he just wants what he wants for his marina and decides the cap rates don't need to apply? All good questions, and there are so many more. But let's start with what a cap rate really is. A cap rate is simply income as a percentage of sale price. That's it. So on a level playing field, and for purposes of this illustration, let's say that the purchase price of your marina is fixed at $1 million. If the marina's adjusted EBITDA is $100,000 a year, that would translate to a 10% cap rate. If the adjusted EBITDA is $50,000 a year, that would be a 5% cap rate. The inference you draw from this quick example is that as a seller, you want the lowest cap rate possible because that means your income is worth more. A buyer would prefer a much higher cap rate because that would result in him purchasing more income for the same price. So when one of those buyers standing on your front doorstep says he will pay you the highest cap rate in the business for your marina, then you can tell him politely to pound sand. The logic here is somewhat counterintuitive because folks who don't work in this business naturally equate a higher rate as being better for them, which in fact it is just the opposite. And by the way, if you would like a free 30 or 40 minute session on the phone to understand the calculations better, or if you'd like to get a general value estimate of your marina or boatyard in a few minutes while we talk, then just call the number below to set a slot on my schedule, and I will be happy to personally walk you through it. I honestly enjoy helping folks get their arms around this process so they can feel more confident in the decisions they are making as to whether to sell and how to go about doing it. So who determines what cap rate to use? Buyers and sellers will each have their own perspective on cap rates, as I mentioned. Sellers usually want to go lower than they should, and buyers always go higher. After making an accurate assessment of your business profitability, your expert marina broker will advise you on where your cap rate should end up. The general average for sellers going to market is somewhere around an 8% average, but that can change based on all that we've been talking about. So basically, if you divide your adjusted EBITDA by 0.08, you will have a pretty good indication of where your value will end up. You may not actually achieve that price, but it should come in fairly close if you want to hold out for the value you deserve. Either way, knowing where a seller stands on his expectation of cap rate will help your expert marina broker sift through inevitable bottom feeders, tire kickers, and nosy neighbors that are sure to call. A seller should be advised by his expert marina broker to determine in his mind an acceptable cap rate based on the facts learned from the calculations performed while analyzing his business. The hard work lies in completing that analysis and those calculations well in advance of going to market. There are additional issues that will influence the rate a seller ultimately chooses, such as deciding how the boat and/or parts inventory will be handled. Will it be included in the purchase price, or will it be paid for separately? And who will own, purchase, or sell the new and used boats and motors subsequent to closing that are still on the lot? Investors will typically push for a 10 to 12 cap deal or more, in most cases because they are looking for a strong and established rate of return on their investment or for their investors. Owner-operators, on the other hand, tend to want to be in it for the long haul, and they see pricing differently. Although cap rate is important, they will pay what the facility is worth more often because they intend to make changes and expand opportunities that will result in more profitability for them over time. Owner-operators are usually quite successful in doing that because they are hands-on at the facility and dealing with the day-to-day. And then to answer the final question about what happens if the owner pays no attention to cap rates or other industry-accepted metrics and just wants the price he wants. He's entitled to do that, but chances are the marina will not get sold. The wide gap in price expectation, which often accompanies that mindset, generally discourages buyers from engaging beyond the initial look. They may feel there is just too much difference in perceived value, and so they simply move on. Sellers have to keep in mind that the marina or boatyard they've run for all those years has provided a good living. Selling is the final step. All of the blood, sweat, and tears it took to get to this point deserve every dollar a seller can get for his prized possession. But there is logic that will dictate how and why buyers will buy and allow you to move on. Your expert marina broker must have his finger on the pulse of the marina mergers and acquisitions industry. And if you have priced it correctly, he should be able to bring the right buyer to your table. That will wrap it up for now, but I hope you will not hesitate to call me anytime if you'd like to talk about selling your marina. I love this business, and I am passionate about bringing value to my customers by doing the hard work and achieving outstanding results every time. I hope you enjoy the rest of the show, and hopefully next year we can see everyone again in person. I look forward to another great year ahead. I'm out.